So it's like you may have a ton of equity like this person with no mortgage. And if they had no other debt at all to help them qualify and they could get the max amount, they wouldn't be able to get the full 80. They would only be eligible for what their income could support at this point. But they would get it at almost the very best pricing because 760 or 800 or higher gets you the best pricing out there, right? Because that's the most important piece in this puzzle, because like a high income doesn't erase bad ratios, right? Capacity is as important as collateral.
If you've been paying your mortgage on time for the last 3 to 5 years, you're basically living inside of a giant piggy bank. Yes and no. It's a little bit more complicated than that. A lot of people looking to leverage the equity in their home assume that that equity is basically just available to them whenever they need it through like an equity loan, for example, like a HELOC or a HELOAN. But the reality is lenders don't hand you cash just because your Zestimate looks good. Credit, income, debt to income ratio, loan to value, these all matter. So how much money do you actually qualify for? Welcome to the channel. We're the Clear Close, the mortgage experts that help you get clear to close on your next mortgage. But before we get into it, let us know in the comment section below what you think the best use for a HELOC is in this economy.
So if there's a topic or question we didn't cover today, let us know, leave a like, comment, and we'll get to it on the next ones.
Okay, so let's get right into it. The main things or the main aspects that lenders look to qualify, these are like the minimum qualifications, right? So any HELOC lender will look at other than just the total equity that someone has in their house. So what are those aspects that they look at?
It's very similar to like traditional mortgage lending. So they're going to look at not just the amount of equity you have, like they're going to look at the combined loan to value with your first mortgage if you have one, with the potential new HELOC. Credit score comes into play. Like, do you have a stable income or job? And ultimately, like, what does your debt to income look like in relation to what you're trying to borrow? So general rule of thumb is most lenders will cap a HELOC somewhere between 80 to 90% combined loan to value. So it's more holistic, right? It's not just about having a lot of equity. We want to make sure you're able to repay on what you're borrowing or have access to in the future. So I guess you could say having equity is like owning a Ferrari. It looks great, but if you don't have gas in the tank, you're not going to go anywhere.
Okay, so let's get into the first scenario or the first simulation. These are hypotheticals, and you may fall into one or two of these different categories, like your home is around the same price or your debt to income ratio is around the same. But this is not meant to be a whole like a exhaustive list. This is kind of just to give you an idea of what the process is, and how much people in these scenarios could qualify for in terms of amount. So the first simulation is the imaginary home is $800,000. There is no mortgage, it's completely free and clear, paid off. The imaginary person has a 750 FICO score, $8,000 monthly gross income.
This person would be eligible for HELOC because they have the good credit. They should qualify, and the 8,000 in income would allow them to take on at least 4,000 in debt, right? A monthly obligation. So as a loan officer or lender, we're pushing and pulling on these levers to make it fit. So it's like you may have a ton of equity like this person with no mortgage. And if they had no other debt at all to help them qualify and they could get the max amount, they wouldn't be able to get the full 80. They would only be eligible for what their income could support at this point. But they would get it at almost the very best pricing because 760 or 800 or higher gets you the best pricing out there.
Nice.
So there'd be top tier at this point. But the biggest limitation would be income. So it's most likely you're going to end up having underwriting approval, but it's not going to be at the full 80 or 90%. It's just going to be subject to what their actual full liabilities are. So you may have perfect equity, right, in this scenario, but borrowers can get capped on the HELOC maximum amount if debt to income ratios are stretched.
And if any of this sounds overwhelming to you because of all the different variables and levers that Jason was talking about, You don't have to worry. That's why we exist as mortgage brokers and mortgage originators. Click on that link in the description, schedule a call with us. We will go through these numbers for you personally so that you know your number. Okay. All right, let's move on to simulation number two. Okay, this imaginary person also has an $800,000 home, but it's not free and clear. Let's say $240,000 of principal left on the mortgage. Their FICO score is decent, 700, and their monthly income is very high. They make 20K a month. I think maybe they're like a programmer or something. And let's just throw in one extra thing, like relatively high debt to income ratio.
Yeah, it's another common scenario, right? People end up having higher income, and the most common thing that I see is lifestyle grows with that income, and now you've got more of your monthly income that you're getting net being spent to service your own debts and liabilities, right? So it's not just a housing payment. If you're at 60% debt to income, you're definitely carrying some sort of auto loan, personal loan, maybe, or even credit cards at a higher balance just because you said 700 FICO, just the pattern that I've seen. It's like if you've got a 700 FICO, you're definitely carrying a lot of balances, frankly, because usually if you look at our Experian data that we have available and we've shared on previous episodes, you'll see like someone that's in 700 has been carrying probably over 50% of their credit limit on credit cards. That doesn't factor in things like installment loans, Klarna, or auto loans and stuff like that. But just general assumption here sounds like this person is definitely carrying debt and it's probably going to be over 50% debt to income in these cases, in these scenarios. And that's where this person is probably going to benefit from a debt consolidation with the HELOC. Because if they own a home that's 800,000 and has a first for about 240,000, they should have access to at least 400 grand, right? Not saying they need all of it, but that big paycheck with 20,000 a month in income sounds great, looks good. But definitely the ratios here look broken to me because 60% debt to income means most of their income is already locked into monthly payments. So they're just one furlough, job loss, or maybe the bonus isn't as big this year to knock out that credit card that grew over the last 12 months. Um, Things can go upside down real fast from this point. So, if you're in this scenario, I would definitely look at exploring your options because you do qualify today, in from what it looks like with this scenario, but it's going to reduce your options moving forward. The HELOC you get on this scenario would be more of a chapter one. Like I call this like a two-step or it's like a book. There's like multiple chapters. Financially, this would be chapter one because we need to fix by doing a debt consolidation first. And then strategically here, using that HELOC, you could end up paying down those high interest rate credit cards, bring your actual monthly cash flow back in line to a point where you're either aggressively tackling repayment of the HELOC or actually able to start putting money to the side so you don't have to run back to the credit cards later, right? Because that's the most important piece in this puzzle. Because like a high income doesn't erase bad ratios, right? Capacity is as important as collateral.
That's a great line. Capacity is as important as collateral. That's a great line. All right, that was great. So let's move on to simulation number three. Eight. This is a person. We're gonna just stay consistent with the home values. Okay, $800,000 home. This person has about half of it paid off, so 400K balance on the principal value, and then 670 FICO score. So they're a little bit under, and their income is 12K a month. It's pretty solid. Maybe they live in California, right?
It's a
Uh,
dual income household, in my opinion. It looks like a true middle class two income household, right? And kudos to this family.
right. So I mean, this is like where most people fall into.
100%. So basically, with this
Mhm.
simulation, if you have $800,000 home and you have 50% equity because you owe about 400 grand on it, and you're in the mid to high 600s, right? With solid income, like 12K a month, that's dual household income. So you have strong equity position, income is healthy. Debt to income ratios look like it could be fine, but you're also on the point of teetering because if you're at 670, that means you've utilized a lot of recent credit. So that means the debt to income could be okay, but you're one or two missteps from the house of cards falling, right? It sounds doom and gloom here, but it could have been multiple medical bills, right? And you just threw it on a credit card. Or someone got a dual income household, one person got less hours for a couple weeks because of a shift or life event happened and they couldn't. And you ended up opening multiple new credit lines to help supplement or temporarily band-aid the situation instead of addressing it. So this is where it could be a tipping point where it was manageable and then it can become unmanageable because it, like I said, like if the ratios were okay and then life surprises hit you multiple times in a row in a short period of time, this is where where I see or hear a lot of stories from customers, and it breaks my heart because I can't help them because they end up having a late payment or the scores
Mm.
just suddenly drop because now it's not just one or two medical bills being put on cards, it's like multiple.
Yeah,
And
cards are getting maxed out.
and then it's like everything's maxed out and now you're not at 670. It's like
Mhm,
literally
mhm.
1, 2 months later or one billing cycle later, you're immediately down to like 600, 619. And now you're in a position where it's like a uphill climb because you have to work more to pay off what you accrued to get to a point to qualify to then consolidate potentially. And the worst case scenario, if all of that continues to go the wrong direction or snowballs, then you're in a position where either you're going to be looking at selling or refinancing your amazing mortgage from Brexit when you got it at like in 2016 for 3.5%, right? Or
Yeah.
during the pandemic in 21 to 22.
Jason, any closing words?
Final comment? Yeah, I mean, just want to recap it one more time. Just went through three scenarios today. Like the first scenario was too much debt versus income, even with having a free and clear home and good credit, right? Scenario two was like, yes, I have high income, but it's also hard if you don't have if the ratios for qualifying your debt to income are stretched or what's the goal, right? And then the last scenario is you have equity and income, but man, your credit scores aren't there because of whatever life threw at you. So equity is just one piece of the puzzle, and lenders care overall about the risk profile, right? It's not just having a free and clear home. A combination of credit, income stability, and debt ratios. They all matter. So again, if you're curious about just how much you qualify for, don't guess based on just your equity. Click the link in the description, as Peter said, and we'll run the exact numbers for your scenario because everybody is unique. You're like your fingerprint on your thumb. No two people have the same fingerprint. So your financial situation is exactly the same way. And we want to make sure this is fit to your specific goals and needs and qualifications.
All right. That's it for us. We'll see you guys on the next one. See ya. Hey, did you know that there are fixed rate and variable rate HELOCs? If you want to learn more about the differences, and the differences are huge, click on this video on the top. If you want to learn how to avoid the most common mistakes people make with HELOCs, click on this video on the bottom.